So I think we talked about it at some point. I know I know I don't know if it was in conversation or this, but I told you at one point, wait until 40-year mortgages start popping up. That's what's coming next.
And talk to me a
They
little
pop
bit.
up. They're
Yeah.
just they're starting to pop up. Like the FHA's already started talking about it. I started reading about it this week. It'll come. It's gonna come. It's a matter of time. I mean, it's just
So
it's
something that was already occurring overseas, right? What benefit is there going to be to the 40-year loan term? It's kind of going to be like the difference between getting a 60-month car payment versus a 72-month car payment, right?
Sure. You're gonna pay more interest. You're gonna pay more big. They're gonna have
Stretch
the
it
term
out.
longer. You're gonna just pay more money. I mean, that's really what it means.
Alrighty, good morning, everybody. Robert Kenneth Morillo, broker associate with Team Aroa at Compass, Florida. License number BK3373543. What's going on, John?
Good morning, John Paul with an MLS 1309244. How you doing today, man?
Doing good. Episode what? 17? 17. It's Tuesday, April 11th. 29 days to May 10th.
So we got we have PCI coming tomorrow. Actually, first let me back up. Housing data keeps on coming up. We touched on it briefly yesterday. Appreciation is close to 3% year over year. It's close to 3% from the peak. The values have dropped about almost 3% from the peak value. So, overall pricing is still houses have gained value overall. So housing strong, as we talked about yesterday. So we got the PCI report coming tomorrow, and as we kind of had talked before, this month's data, the housing sort of flag, the roller coaster, right? We're kind of there, so we don't know what the number is going to be for housing, the cost of housing, but it's kind of peaked, so it's there, right? It's at the peak. We're going to see what the number is. The jobs data just came out at the end of last week, so they're still showing. It looks like unemployment is low, so that's putting pressure. Inflation, we'll see what the reading comes out. We got a little bit of gas prices have been kind of creeping up last couple of weeks, so we'll see what the data points to on the inflation rating. The year over year number that they use for comparison last year was really low. That's what we touched on this before, right? So this report, we didn't know what it was going to the data's we didn't know which way it was going to go, but based on the housing data, it's probably not going to be pretty, because it's going to look like inflation's it's going up, and then what that'll trigger is, oh no, the Fed's not going to stop because inflation's still going up, and it's just madness. It's going to repeat itself. What's been kind of repeating itself. So that's kind of this month's the expectation. We should expect some of the same thing, like just this. We're in between two boxes, and the rates are kind of moving in there as I should in that chart, and it's just bouncing in there. Yeah, I mean up and down, depending when you catch it. Yeah. Today would be, if you haven't locked the loan, call your LO and lock if you can before rates come out. Before rates come out, before the PCI numbers come out, because that'll trigger. If you're able to, to catch it if you didn't lock yesterday, because rates would probably do a bounce up and do a pricing, or have an impact on rates. So it's another, we gotta, this week we'll see what the number is, but there's no really expectation that it's going to have anything that's slow. Yeah, because the year over year number, the May 10th is much higher last year than this year. And then that with the combination of so it's like two charts, right? Two lines, right? So if you have housing here at the bottom line, and you have last year's numbers at the top line, if housing is up and last year's number is low, there's not a little room to move. In May, the May 10th report, last year's number is high, and the housing should be on the way down. So there should be some room in there for the inflation number to come in, and the reading at least be lower.
So you know what it feels like? It feels like, when you're going up on the roller coaster and it's just clicking and clicking
and you're waiting.
And you think you're about to go down, but it keeps going higher and higher.
Yeah, it's got a couple of extra clicks. You got a couple of extra clicks in there.
Yeah.
Well, yeah, because if I've been on it where when I was, you close your eyes because you don't want to see it. And you think you're there. You close your eyes, but then you're like click, like you're still winning. Absolutely.
Yeah, like how much higher can we go?
That's exactly what it feels like. Yeah. So
that's
where we're at. That's where we're at. With numbers this week. Lock. It's going to be messy.
Okay, so that's your advice to buyers who are in the process and they have the as long as they have the ability to lock ASAP. Yeah,
absolutely.
Okay, cool. All right, so today's topic, we're gonna be talking about jumbo loans, and essentially, I mean, we know being in Orlando, we have those pockets in the market that are considered ultra luxury. So considering jumbo loans, how do you define a jumbo loan?
So a jumbo loan is just, I'm not sure where the number came from. I assume because it's large jumbo, but it's a non-conventional loan amount, or non-conforming loan amount. So you have Fannie and Freddie, which are your two main investors for conventional or conforming loan amounts. And that switches every year based on property values. This year's conforming loan limit is $726,300.
Okay.
If I'm not mistaken.
And that number went up with the FHA loan limits as well this year, right?
They're independent of each other, but they go up every year.
Okay.
And Fannie and conventional actually come out first, and FHA come out next.
Okay.
But they are, they both usually, one goes up, the other one goes up. And it's just based on just property value. So that's really, it's just the base loan amount. That's just the limit, right? So if anything above that, it's considered a non-conforming or short jumbo loan. That's really, I mean, the parameter, what makes it go from a conventional to a jumbo, it's the loan amount.
Yeah, exactly.
And or the purchase price, right? I mean, if you have $1 million property and you put 200,000 down, you're putting 20% down, but you're still on the jumbo territory. But if you put 30% down, but if you put 30,000 down, 30% down, now you're at 700. Now you're in conventional territory. So it's not so much the purchase price; it's more the loan amount.
Yeah, and that's for buyers out there who don't understand that, right? Like, your loan amount does not equal your purchase price unless you're doing 100% financing, which
correct. USDA or VA loan.
VA. Correct. Yeah.
Even then, it's technically not 100% financing because it's actually over 100% financing, but that's a different conversation.
What makes you say that? It's over 100%?
Yeah, because both in USDA and VA, they add the funding fee. And they add it to the loan amount.
Oh,
you buy a $300,000 house, you have a funding fee, you put the VA funding fee, it's $300,000 loan amount plus the VA funding fee. So it's technically above 100%, right?
So they allow the funding fee to be financed.
It's financed, yeah, and USDA as well. It's the same concept.
Okay, but I'm pretty sure buyers have the option to cover that funding fee out of pocket as well if they wanted to.
Theoretically, but they usually don't. I mean, if they're buying 100% down, usually they're not using money to, they're not using the money to put it down, if you would, to pay it off.
Okay, and so what are the loan limits that are set by Fannie and Freddie, and how do they affect the availability of the jumbo loans? Like, is there kind of like with the Hometown Heroes program, there's only an allotted budget for that. Is That does
Oh,
that apply?
no, because there's no, that's all based on the, like Hometown Heroes is the type of program that it's like, it's with the state, right?
Mhm.
So there's X amount of funds that are available for that, and that's where there's caps and there's limits and income limits and all these things. Jumbo loan is just it's a different animal, right? So what a jumbo loan does, it could be, I mean, it's really based on, it's a higher risk. It's a higher risk product, right? So the way lenders look at these things is it's really based on risk, right? Lenders, they really only care about one thing. It's getting their money, like their interest, right?
Yeah,
Or
their
the return
interest,
on the
yeah.
investment. So I mean, it's a business, right? So I mean, that's what it is. So the higher the risk, that's how these things are sort of priced, right? Depending how much risk comes to the lender. So on the jumbo, because it's a higher loan amount, obviously it's higher risk. There's jumbo loans that, and there's many different investors, and it's hard to have a conversation, with Fannie. There's a set of guidelines. Fannie and Freddie, they're both sets of guidelines are extremely similar, and there's slight differences here and there between two of them. For example, what do I mean? Conventional Fannie, conventional investment property is 25% down payment. Freddie, conventional is 20% down payment, right? So there's a 5% difference between one and the other. Another one, and it's same investment. Fannie, Freddie, you could do 15% on a single family on investment.
15% on the single
So
family.
you can do 15% on an investment with Freddie, right? So there's slight differences, here and there that are not, not very slight, like very different in specific sets of guidelines, right? Specific, the LTV, loan to value, investment, 5% between one and the other. I mean, slight differences. On jumbo, you can have, I mean, there's so many different options, and there's so many things out there that it's hard to like put them all in one bucket. It really is, because you can do theoretically, there's programs that, depending on your credit score, because it's all based on risk, but you could do a jumbo with 5% down.
Okay.
And it's capped at loan amounts, and it's like I said, it's too hard to like tell you one specific, but it could be as low as 5% down, and then goes up from there, right? So it really depends on your credit. But so the higher your credit score is, the more flexible and the more options you have. There's a lot of jumbo programs that don't have mortgage insurance, which is obviously a big, so if you do 10% down on $1 million home, $900,000 amount, no mortgage insurance. If you were paying mortgage insurance, that'd be a big hit. That's a big payment. So just that's the loan amount. So there's different options depending on the investor, but it's a complicated area to kind of, you can't really generalize. Another wrinkle that gets thrown with jumbos is there's a lot of smaller banks or credit unions, for example, or a large bank for that matter. I mean, it doesn't have to be a small bank, but there's a lot of portfolio programs that they have, like that they keep in house, that they're not necessarily selling.
They're not going to resell after closing.
Correct. So you got you got a bank, you get one of you get somebody, and they tell them, obviously if you're buying, if you're doing jumbo loans, you're talking about a different income level, right? So it's a higher income level, a higher bracket. So deposit $1 million into an account, and we'll give you a quarter off the rate or something like that. So they can play with that. So the rate is a complicated subject. It's not as easy as what's your rate today, because they could, if the buyer has assets, they can deposit them, if they deposit into an account on a 6-month CD, or I don't know, a year CD, whatever they entice them to, and we'll give you X off your rate. And so people will do that. So it's not really but in general terms, it's loan amounts that are over 726, 300. It's more restringent as far as the guidelines are, more restrictive.
So for eligibility, let's just say, for instance, what's the minimum credit score somebody can get a jumbo loan with?
Depends on the loan amount, on the loan to value, down payment. So you know,
Okay.
you could, if you have enough money down, above 20%, 25, that depends, right? It really depends on the type of product. Like I said, it's complicated to just narrow it down, but you could get in there as low as like 660. You're gonna be high, you're gonna be paying rate, high down payment, but you could get in with as low as a 660.
Yeah, but typically, people who can afford a jumbo loan typically tend to have better behavior and habits that allow them to have a better credit score.
Correct. So the score threshold is much higher in a jumbo. So to be a player in the game, you need to be in the 700s, and that's where it gets, and the higher the obviously the better, because that gives you more options as far as less down payment or no MI option, or just lower payment, overall.
Yeah.
And rates on jumbo are gonna be higher than conventional.
How do they differ from a traditional mortgage?
Again, it depends on which way you're going, because it's the range is so wide. 20% down, 760 credit. You know what I mean? It depends on, you can't really compare apples and apples. Jumbo tends to be higher. So if you're going to buy a jumbo loan, you tend to be on the higher average interest rate.
But do interest rates go into the double digits for a jumbo loan, or would you say they still stay?
No. They still. I mean, they're not too far off from, like, right now with the rates are so high. They're not too far off. Like they're closer to each other.
Okay.
You know what I mean? It's not,
so kind of like doing a hard money loan.
Yeah, I mean, it's kind of yeah. I mean, it's just your rate's going to be slightly higher. Again, it's a higher risk. It's a different animal. It's a different product. And it's very boutiquey. It could be very boutiquey and there's some jumbo products that are only available in certain states. Well, if we're here, as you said at the beginning, there's pockets of areas. In a place like California, for example, pretty much every loan's a jumbo loan. Even though there the loan amounts are high. Well, FHA loans amount are higher anyway, because it's a high income area or high price area. So they're different. The income limits or the loan amount limits are higher. But in California, jumbo is pretty much the norm. So there's some products that are only like available in California, let's say, because they're local lenders from there. So it's just it's a space that has a lot of information, a lot of different players in. So it's really hard to kind of peg and say, here's the minimum, here's the, we're FHA, it's easy, 580 plus 3.5% down, it's a much simpler sort of guideline, if you would.
And what documentation, is there any documentation different from a traditional mortgage that would be required?
Same. I mean, you're same kind of process. I mean, there's really no difference. There's some additional requirements, not so much in the sense of documentation, but for example, reserves. On a jumbo, reserves is it's almost like it's included in every single one. Like, there'll be few scenarios where you have no reserves, like 1 month, 2 months, some could be 12 months. Again, it all depends on the score, and it all depends on the loan to value and the type of program you're looking at. But reserves are that's one thing that for the most part you're always going to be counting on reserves. But as far as documentation, it's same process. You got to verify the income, you got to verify the assets, the credit, the employment. There's no much difference between one or the other as far as requirements for qualification.
Gotcha. So what are the benefits to going jumbo versus, like, let's just say, if $1 million property, would it be better for someone to put in that amount to get them more conventional, or
100%? If they have the money, 100%.
Are there any benefits you would say to a jumbo loan? Like, let's just say, forget about it. Like for instance, we did the quote for my buyers that were shopping in the Golden Oak. You know, what are the plus side of jumbo loans for loan amounts that are larger than 10 million, let's just say?
But it's, I mean, it's all at that sense. There's really no, because you don't. There's no, you can't really break it down like that, right? Because if you're buying a $10 million property, it's either cash or a jumbo. Unless you buy a $10 million property and you put, 9.3 million and you borrow 700,000, right? And then you would have a conforming loan amount, right?
Yeah.
So there's, you can't really compare it that way because there's really no, you have no option. It's either, it's either.
Are there any interest only options for jumbo loans?
Oh yeah, there's arms and there's all kinds of, usually for the most part, except the period we just experienced with the, when the rates were so low, right? But usually, when you see jumbos, the conversation is arms.
Okay.
That's it's not a rule, it's nothing like that, but usually they kind of go hand in hand, except like I said, in this period we just passed, that there was the rates were so low. At that point, there was really, arms were just really not a thing, and the 30 years were low enough that everybody was doing 30 years or 15 years. But typically the conversation on a it's an arm on a jumbo, just like typically the conversation when rates are this high, it's really an arm. The thing is that arms are now not a thing because we talked about this in the past, like it's just the pricing and the difference is so high, and it's so that the servicing, the value, they're charging it up front because they know people are going to refi because it's so uncertain, the market is
so on an adjustable rate mortgage, you can anticipate when the adjustment is supposed to occur, right?
Correct. Yeah, if it's a 5-year arm, you're going to be fixed for 5 years, and then in the 6th year it'll adjust every year.
So you're getting ready to refinance by year 3 or 4.
Not necessarily, right? I mean, again, this is all the issue comes in, right? There's all these tools and programs that are there used in this space, in the jumbo space, right? Like for example, there was a thing called, you probably never heard of this, but pay option arms. You know what that is?
Pay option arms? Yeah. I can't say that I know. No.
So in the market crash in 2008, there was a lender called Countrywide Home Loans.
What?
Countrywide Home Loans. Yeah, they were a very, very big lender. Just like Washington Mutual was another huge lender, right? WAMU is what they used to call that. So
WAMU, yeah.
So they came up with this thing called pay option arms, right? And what a pay option arm is an adjustable rate mortgage, and you have the option of what you want to pay. So you could have paid principal and interest. You could have paid interest only. You could have you could have let it go negative arm. You could have paid less than the minimum interest, and then it became a negative arm, negative amortization. So if your interest, this month, if the cost is the interest payment is 1,000 and I send 700, I'm sure 300, that 300 gets added to my principal, and it just gets added every month. So that was a pay option arm, and that caused a lot of problems in the industry.
Yeah,
because that's a tool that is used for so somebody, an investor, right? And it's usually it's people that have money, right? It's just
the wealthier class.
The wealthy, the one of the reasons why they're wealthy is because they know money and they know the rules and they know how to use it and how to play and utilize those rules to their advantage. So they have these
use different loan types as a tool.
You have these different loan tools with these people that have these different kind of assets and these different investment things, and a pay option could be, depending on the situation, a really good tool to have, because you could take your money from here and you're paying less, and you invest it here and you make more, and then if you're doing that, then it's a great product for that. What happened is that the industry took that product that was there for, that was being utilized by a certain group of people who had certain knowledge and how to, and certain assets to be able to play that game. And they introduced it to the whole population.
They tried to mainstream it.
Well,
Or
and not only that, but they tried to, they did it on a pretty serious, large risky investment, which is somebody's home, a large investment, right? The amount of money. So
the largest purchase that they'll ever
make. And then not only that, but they piggybacked it on top of a program where they didn't verify people's income. It was stated. So they didn't know if the people could afford to make the payment or not. They said, on top of that, you decide how much you want to pay.
Almost bound to fail.
What could go wrong? We don't know if you make enough money to pay for this, and we'll let you add the principal, the interest to the principal every month. So your debt is growing every month. What could go wrong?
And you can tell us how much you make, and we won't even check it.
It will believe you. So. But we digress. But that's kind of so there's these different tools that are utilized, right? So back to ARMS, right? ARMS is another, it's another thing. It's a vehicle, right? You put in your money, you go in 5 year. I'm going to make this investment. I'm going to do this. I'm going to do that. I tie my money up here for 5 years, but in 5 years I'll get money from somewhere else and pay this off or do something or sell it. Like these investors go into these transactions with a plan. Unfortunately, for the majority of people, they try to kind of do the same thing, but they don't have the knowledge and they don't have the plan, so they buy a jumbo and they buy an ARM, and when the ARM is due, I got a refi, but what if the rates are higher? What are you gonna do? Or what if the property values have decreased and you can, there's just, those are all risks that you have to take into consideration when you kind of get into the jumbo space. So ARM is in the jumbo space, that's just people prefer to go the ARM route because the initial rates are lower than on a 30-year fixed, and that's sort of what that borrower it utilizes, like shorter term. They put their money, they play with their money, they're making these investments, and that's how they do it. So it's more of an adjustable rate, on the conformance side, right? And usually, I shouldn't say usually, but it's been my experience anyway. It kind of starts with the government loans, and then they expand to conventional. Where those parameters change is they're trying to expand home ownership. So I think we talked about it at some point. I know I don't know if it was in conversation or this, but I told you at one point, wait until 40-year mortgages start popping up. That's what's coming next.
And talk to me a little bit.
They're starting to pop up. Like the FHA's already started talking about it. I started reading about it this week. It'll come. It's going to come. It's a matter of time. It's just.
It's something that was already occurring overseas, right? What benefit is there going to be to the 40-year loan term? It's kind of going to be like the difference between getting a 60-month car payment versus a 72-month car payment, right?
Sure. You're gonna pay more interest. You're gonna pay more big. They're gonna have the term longer. You're gonna just pay more money. That's really what it means. So for the lenders, it's more money. For the investor, it's more money. It's 10 years of extra payments. It's 120 extra payments. No matter how you slice it, it's a lot of money. But what it does is it creates an affordable monthly payment. An affordable monthly payment, right? Affordable, in quotes, right? What does affordable mean? It doesn't not necessarily mean that you can afford it month to month. That does not mean it's affordable.
Yeah, it's less is more. So less monthly payment, but more interest over the life of the loan.
Exactly. So that doesn't, just because it's an affordable.
You're taking that phrase to a whole nother route.
It's a whole different conversation you got to have, but you got to be able. Okay, so it's not all bad, right? Because again, you got to have the conversation. And what's the term on a rental, on a renter? What's their term?
Yeah.
Like what's it? What, like a 30-year mortgage? The term is a 30 year, right? On a 30-year mortgage. So a first-time home buyer, right? For married couple, first home. Just married couple with 2 kids, just buy their first home. And they get a 30-year mortgage. What's the term of the mortgage?
What do you mean?
On a 30-year mortgage for a first-time home buyer, they've never owned a home before, they get a 30-year mortgage. What is the term of the mortgage? How long are they going to be paying the mortgage for?
For 30 years, presumably.
Correct. Same scenario, same couple. They say, you know what? Home ownership is not my thing. I'm going to rent. And they rent. What's their term of their rental agreement?
Typically a year.
Well, no, for their lifetimes. If they never buy, they're going to rent forever.
Oh, gotcha.
You know what I'm saying?
I see what you're saying.
A 30-year fix is 30-year. A 40-year fix is 40-year. But a rental term is until you die. Right? I mean, you just or you hit the lottery, or somebody says, let me give you a house you don't have to pay for, right? I mean, that could happen, but typically
you inherit a property.
Yeah, or but if you don't, if that's not, if you're not that fortunate, then you're going to pay rent for your lifetime. So that's 30, 40, 50 years, how long you're paying rent for. So, you have to really look at it that way, because that's really what it means. I mean, it's not going to go away. I mean, it's like the conversation with the solar panels, we had, it's the same thing. I mean, oh yeah, you're going to get a loan for 25 years. I don't want a loan. Okay. How long are you going to pay electric for?
Forever.
How long is your electric bill going to go for? I mean, it's not going to go anywhere.
Let's light the candles. Take it back to the old.
But putting the grilling your steak with a candle fire, it's going to take a while to cook. You know what I mean? It's complicated. So that's how you look at it. By the way, I looked at my electric bill the other day.
It said winning. It just said winning.
I love it, man. That brought joy to my side. Let me
guess. You didn't have to come out of pocket.
Well, no, I have a minute. So I have the bill. Like you got to pay $15. You can't get rid of it. Like just that's what it is. And then I have this other like insurance thing for like my plumbing and the outside with the water lines. It's like $26 that I pay for that, but that's not electricity. That's just something that goes to the electric company. So I pay $43. It's kind of but it's not an electric bill. It's just the bill, the $15 that you have to pay no matter what, and then the charge for that insurance. But I also get a credit that gets applied. The net metering credit, they adjust it at the end of the year. So every month I get I pay the minimum, but it's not electricity. My electricity gets credited, and at the end of the year is adjusted, because there's some months that you produce less and you consume more. But like this month I produced 700 kilowatts, so extra. So it's nice. Sweet. It's like woo.
And so let's say in the summer months when your kids are home all day, they're not going to school or not, out and about, and you're consuming more, then it balances out more or less like what you have produced extra, right?
I mean, I don't know. We'll see what in my case, I mean, I don't have kids, but I mean, I do have kids, but they're not little kids. But they live at home. So we're here, the AC is always on. I don't like to be, feel hot, you know what I mean? So the AC is always on. We're not over here like, shutting the water heater off so that we don't consume energy and you know what I mean? That we just live a normal life. I mean, the AC's on, the lights, I mean, we have a normal life, and I'm charging two electric vehicles, so that's sweet. I digress, but that's another plug for solar. I mean, it's a beautiful thing, man. I mean, it's only in America. Like I sound like Don King. Only in America.
That's so funny because it's so true. Like you're at risk in other countries to essentially have no electricity.
I mean, this would never happen. Like just what it would never happen anywhere else in the world. It can never happen anywhere. I mean, the between the tax credits that I got for buying the panels and buying the 2 vehicles. You put the tax credit into an equation, and then you're getting I'm basically producing the energy to live and to drive my cars. I mean, it's insane. I mean, it's just for pretty much the same amount of money that or depending on what month, either pretty much the same amount of money, and some months less.
Some months way less, because you're at least it's a steady payment, no surprise bills.
Correct. It's not going up. I mean, it's just like it's only, you can only see that in this country. Any other country, it would never work. It would never. I mean, they would never do that. And the amount of money that it takes from the government to do that, it's massive. I mean, that's part of the problem we have, is all this massive money, but you got to utilize it.
Yeah,
You got to use it. You got to. I mean, it's there. You have to use it. Take advantage of those things.
So, any last thoughts on jumbo loans before?
I mean, jumbo is a space. I mean, unless you live in a state that, like California, where you really have no choice, because the property values are so high, you're really, you're kind of just dealing in that space alone, jumbo or non-conforming. I would say it's you definitely have to be a more savvy, more knowledgeable of what you get into. So just, be leery of, your first home and your first loan is going to be a jumbo luxury, $3 million loan. It can get messy. I mean, it's complicated. So just be careful. Just get your information, get the advice, just educate it, and team up with a team,
right lender,
that's going to bring you and it's going to guide you. I mean, it's really what it is. That's what the bottom line is.
Okay. Awesome. All right. Well, if nothing more, Robert Morillo with Team Aroa at Compass, Florida, license number BK33735443. Let them know, John.
John Sepulveda, origin point and MLS 1309244. Hope the information was valuable today.